Well, it's Monday evening. Uh, I'm Seth Golden, your host, Chief Market Strategist at PhenomGroup.com. Got futures just opened here this Monday evening, slightly in the green after yet another down day in the markets. We're going to go over our weekend research report with a little more detail or context as we've been doing over the last 3 weeks. As I said before, I'll try to keep this going because I know sometimes the written word is not as easy as the verbal words to extrapolate the totality of what we're looking at so far as technicals, fundamentals, as well as quantitative data on a weekly basis in our weekend research report. As always, if you don't receive our weekend research report from phenomgroup.com every Sunday and our state of the market videos every Thursday, subscribe today. It's only $9.99 a month. If it doesn't suit your fancy, you can cancel anytime. With that being said, let's jump right into reviewing this weekend's research report. Whoops, wrong. Okay, sorry. No, I'm not getting a divorce. I do divorce care for my church every Monday, but we had some cancellations today, so we don't have a service this Monday evening. It's one of the ways I serve at my church. I help divorcees through the process of whether they're separated or divorced, just dealing with the emotions and getting to know themselves as a single person again. Different. Okay, never mind. All right. So the title of this weekend's research report: Markets are on knife's edge. Right? Doesn't sound great, does it? But we had a really awesome 2-day rally at the beginning of last week, which alleviated a lot of the oversold conditions. Unfortunately, the 3 subsequent trading days into the end of the week gave back a substantial portion of that 2-day rally. In doing so, it didn't necessarily put us back into deeply oversold conditions. So technically speaking, we're coming into this week not oversold, even though we're still down on 24% in the S&P 500. But we're not oversold. The conditions aren't oversold underneath the surface of the indices. Key chart that we talked about here in the weekend research report is the fact that, look, you're getting a bear market. And I know it's not fun. I say that week after week, but when you look at the graphic of bear markets versus bull markets, it puts it into better perspective. You're getting a discount. And these bear markets don't last very long. Some will last longer than others. The average bear market without a recession is 7 months. With a recession, it's about 11 plus months. All right, this one is looking like it's going to be 10 months old. And we still don't have a recession, which tells you there's something else going on here. We know what that something else is by now, right? It's a derating cycle predicated on going from zero on the Fed funds rate to 300 plus basis points. And by the end of the year, we could be at 400 plus basis points. So we have a derating cycle. We still have earnings growth, even though it's less than where we expected it to be at this point of the year. Nonetheless, in this chart, it tells you, bear markets, brief. Look at the gains in bull markets and look how long they last. 3,999 days from 2009 to basically 2020. 4,494 days from basically the mid 1990s, the mid 1980s, up to 2000. Here in the 1970s, 2000 days. Here's 1,000 days in the early 1970s. The worst bear markets, 2 years in the early 1970s. Most bear markets, like I said, the average is with the recession 12 months. Take advantage because these bear markets, while they seem like it's forever, 10 months, it seems like it's forever. It's not. It just feels that way in the moment. It can be demoralizing. I get it, but you got to put it into its appropriate context. Same thing with NASDAQ bull and bear markets here, folks. The number of days in a bear market, the average 201 days going back to 1973. When, NASDAQ composite started in 1971. Lo and behold, the first bear market was in 1973, only 2 years young, and you got a bear market in the NASDAQ. But the average duration is 201 days. The average duration of a bull market for the NASDAQ is 841 days. The maximum length of a bull market for the NASDAQ was 3,400 days. Note that the NASDAQ will have more bear markets because of its concentration than the S&P 500. I'm going to, scroll a lot here to some of our more compelling charts and things we, probably want to have a greater discussion on. And I don't want to make this too lengthy. If you want a really good, weekly update that covers like, everything under the sun, I would be, subscribing, hit the subscribe button to Hedge Fund Tips by Thomas Hayes. I mean, his videos are an hour plus in length many times. So check him out. Again, I don't do a lot of recommendations. So when I do, I think it should be heeded. Good guy. Very all right, we got cut off there. 1 second. Here we go. All right, so one of the things we talked about, S&P 500, still above the pre-COVID levels here. But at this point, we've already tested the 3,500s in the S&P. At this point, with CPI being what it's been, sticky, the Fed being steadfast in raising rates, we would be of the opinion that through the upcoming earnings season, there's a higher probability that this becomes a mandate and we just get into the 3,400s, which is perfectly acceptable. We've outlined the roadmap for, where we would be looking to add some serious tranches, dollar cost averaging, thinking about index ETFs. Part of that roadmap was revisiting 3666. It was 3558, where we would be adding, if we have 30-40% cash on the sidelines, we would be looking to add upwards of 10%, exposure to the S&P 500. Or if you want the NASDAQ, thinking index ETF wise. Well, if 3,400 is an objective at this point, if we're convicted about that in the 3,400s, it doesn't have to be spot on 3,400. Maybe we do halvesies here, right? We talked about 10%, adding 10% exposure to the market. So that would be basically 3 1/3, tranches times 3, 3 1/3 here, 3 1/3 here, 3 1/3 here, assuming it gets down to 3,260. But it seems more likely that we're going to have a 3,400 handle possibly. So maybe we do halvesies here. Instead of 3 1/3, we do something closer to 1.7, 1.5, and save the other half, if we do get 3,400s handle. Again, thinking more practically or tactically, if you will, assuming, again, this might be just a mandate. And why do we say that? Because it's already happened to the average stock. The average stock is trading at or below its pre-COVID highs. How do we know that? We look at the value line geometric index. It's basically the average stock index. Okay. And that's come all the way back. Here's the pre-COVID highs. Here's 2020. That's the pre-COVID high where it took its plunge, and it's basically finding support, not at the pre-COVID high. It's already broken below that, had to bounce off of it last week. But, right there is the 2007. We're back to the average stock in the S&P 5, the average stock period is back to its 2007 levels. But they keep telling us the market's overvalued, right? But again, this might be the mandate, not just for the average stock, but for the S&P 500 as well. Get back to those pre-COVID highs. No guarantees. There's nothing suggesting it has to happen. or that it won't happen at this point. We need a fundamental catalyst. Right now, it's been absent to change the dynamic sentiment of the market, to change sellers' minds into buyers. One of the interesting things is when we did a relative performance ratio inside of our weekend research report. So we're taking the value line geometric index, the average stock index, relative performance to the S&P 500 itself, and it's been going up while the S&P 500 has been coming back down. This was up last week relative to the S&P 500. What does that tell us? What does it mean? It's basically saying that investors are becoming stock pickers down here. They're picking up individual stocks for one reason or another. It's a sign of risk on appetite, really. It's a little weird at this stage of the bear market where the market internals themselves are on knife's edge, begging of actually additional downside in the market, which we did get today. So this was no surprise to us today here that, on Monday, the major averages were down once again. This is what we anticipated because we didn't have oversold conditions. We're failing to break out of any resistance level. So what do? You chop back down to the downside. But it's interesting that individual stocks have actually been outperforming the S&P 500 as of last week. So we'll see what happens. And it wasn't just last week. Well, the markets were down Wednesday, Thursday, and Friday. Wasn't the value line geometric index relative to the S&P 500? No, it wasn't. For whatever reason, they're not selling individual stocks to the same degree. They're selling the index. It's a little bit of risk on appetite. Again, it's not showing up in the major averages, but it is to some degree underneath the surface. Another relative ratio performance that we looked at was IWM, small cap Russell ETF, if you will, versus the Spider ETF, the large cap S&P 500 index ETF. And this is interesting also because small caps tend to be more risky, right? You don't have earnings. You tend to have a higher PE ratio. What happens to higher PE ratios in a bear market? They get beat to crap. So you're taking bigger risk if you're going after small caps. And yet small caps have been outperforming the S&P 500 index ETF since May. Not only that, but they haven't even come close to retesting the lows. And they're making a series of higher lows. Indexes are coming down. The Russell itself is coming down. For whatever reason, folks are not, buying or they're not selling small caps to the same degree they are selling large caps. Why? Again, underneath the surface, it's a bit more risk on than the indices, the index levels, which are finding lower lows here year to date, would suggest. Bit of risk on here when you look at the performance ratios once again. Another chart we looked at was the NASDAQ 100 versus the S&P 500. This one's been in a nasty downtrend basically since late last year, fourth quarter of last year. It hasn't made a lower low yet. It made the low back in May, just like small caps versus the S&P 500. The NASDAQ 100 versus the S&P 500 also made its low in May. Now, why is this relevant? Because in each of the two past major bear markets, the dot-com bubble bursting and the great financial crisis, the NASDAQ 100 tends to bottom 4 to 6 months ahead. The ratio tends to bottom, I should say. The ratio tends to bottom, NASDAQ 100. Let me blow this up a little bit, see if I can, yeah. So this is the NASDAQ 100 relative to the S&P 500 index, tends to bottom before the S&P 500 itself. Here's the relative performance ratio bottoming here, but the S&P 500 didn't bottom until there. And same thing in the great financial crisis. This was the bottom in the performance ratio, but the S&P didn't bottom until right there. So that performance ratio tends to bottom. Well, the NASDAQ 100 relative to the S&P 500 tends to bottom 4 to 6 months before the S&P 500. We're in that window right now. It bottomed in May. Let's see if I have, yeah, there we go. It bottomed in May. June, July, August, September, October. And that's why we don't want to see this performance ratio make a lower low. Because if it makes a lower low, historically for bear markets, that means the S&P 500 has still not hit the lows. Because the performance ratio tends to bottom 4 to 6 months ahead of the S&P 500 itself. It still hasn't made the lower low, even with last week, even with today. I think I had the chart up earlier. No, today it still didn't make much downside here. So it's a key performance ratio, to look at going forward. Some of the fundamentals that we talked about this weekend: job openings took a big dive. The market likes bad news, right? We have now, instead of having 2 jobs for every, employable person, we have like 1.7 jobs for every employable person. So, I mean, it's still elevated, right? We still have over 10 million jobs. This is where we were pre-COVID, right? Right around 7 million. We still have 10 million. But it was nice to see it come down, because the Fed wants weakening employment and labor markets. It wants them looser. We're still growing jobs at a very healthy clip. For the month of September, as reported last week, non-farm payroll report, 263,000 jobs, slightly above the estimate. And it's, more modest than in previous months. So job growth is slowing. Good, great, but it's still high. And the worst part about the jobs report from last week is that the unemployment rate went down from 3.7% to 3.5%. Wage growth on a year-over-year basis came down, which is good, right? Wage inflation tends to be sticky. It's one of the things the Fed wants to fight, needs to fight. And it did come down a little bit, but that unemployment rate dropping back down, almost to all-time lows. I think the all-time low is 3.4%. Not what the Fed wants to see. The market had a nasty sell-off on Friday, in part due to that, unemployment level coming way down. We did a lot of work here showing that, because people talk about, well, when the employment rate ticks up, will be, that'll be a signal for a recession. Jesse Livermore did this really great report showing not quite. There's more nuance to understanding the unemployment rate and its ability to signal a recession. And he used the 12-month moving average line for the unemployment rate. Historically, you need the 12-month moving average of the unemployment rate. You need the unemployment rate to move above its 12-month moving average. So right now, the unemployment rate went from 3.7% down to 3.5%. The 12-month average of the unemployment rate is 3.9%. We won't historically be signaling a recession until we get above the 12-month moving average, which is at 3.9%. So these red dots here are signaling when the unemployment rate gets above the 12-month moving average, yeah, you get a recession. Above the 12-month moving average, yeah, you get a recession. Here, above the 12, every time you're going to have a recession, going back to, this is the 1940s. That's only 40 basis points away. From 3.5% to 3.9% is only 40 basis points. But, the way this economy is still humming along and has accelerated through the Q3 period into the Q4 period, we're still growing jobs at a healthy clip. We're still growing jobs at a healthy clip. And the way that we're doing so, as LPL Financial hints at, we're doing so that helps the Fed basically produce a soft landing as opposed to a harsh recession. Let's see what else. What else do we want to talk about here? Yield curve, right? We've got more than 55% of the yield curve combinations inverted. But the one that's not inverted, oddly enough, is possibly one of the more important ones, the 10-year minus the 3-month. The 3-month yield curve. That has yet to invert. Not many are talking about this, but the 10-year minus the 3-month yield curve has never inverted throughout the current cycle. And now it is actually steepening. In the past 8 recessions, this yield curve inverted before the recession started. And yet, it hasn't inverted yet. There are many different indicators that we look at here, Phenom Group, and outline in our weekly research reports, identifying that for all of the people pounding the table, we're already in a recession. No, there's almost no signals of a recession that has happened year to date. Chart comes from Carson Wealth. Just a heads up there, giving credit where credit's due. In terms of the CPI data to come out on Thursday, because it is a very important inflation data week, we have the producer price index out on Wednesday, followed by the consumer price index or CPI on Thursday. While the producer price index is important, the headline this week is going to come from the consumer price index. Unfortunately, most of the data is suggesting yet still a bit of an uptick in the inflation data this week at a much more moderate pace. The year over year is still expected to come down for CPI, but the core is expected to remain sticky, if not take another couple tenths of a percent higher. We'll see if it happens. We've been talking about this for a while. The biggest problem is some of the lags in the various line items, especially those line items in the consumer price index that are most heavily weighted, including, of course, shelter and owner equivalence rent. So we'll see. Maybe there's a surprise. You know, everybody had been expecting it to tick lower in the previous months, and it didn't happen. Now everybody expects it to tick higher. Wouldn't it serve to figure that it actually finally ticks lower? Not a forecast, obviously. We'll see what happens. But in terms of we need a fundamental catalyst to turn this market around and produce the typical fourth quarter rally, I would be of the opinion it's got to come from the inflation data. Because if it doesn't come from the inflation data, it doesn't impact the Fed's potential to pause by the end of this year and maybe start shifting its message when it comes to, you know, forward rate probabilities and monetary policy. What else do we got? All right, scrolling. Keep that. Here was one that I hinted at in our last week state of the market. It's from the sentiment trader, because we, remember last week in the first 2 trading days, Monday and Tuesday of last week, we gained more than 5.5% in the major averages. 2-day rally, significant thrust. Sentiment trader data shows very similar to the action in March 2020, right? The lows, COVID lows. Monday and Tuesday witnessed overwhelming buying interest. On the NYSE, 5 times more securities advanced than declined, and 10 times more volume flowed into advancing than declining securities. It's rare to see so many stocks, preferred securities, and fixed income rising at the same time. Even going back to 1928, this hasn't happened too many times. We have less confidence in breadth metrics before 1950, so we'll limit the look back to then. Basically, they're starting the data from 1950 forward. When 5 times as many securities rose as declined on consecutive sessions, Monday and Tuesday, the S&P 500 never suffered a negative 1-year return. So 12 months from the closing price on, well, that would be Tuesday, last Tuesday, 12 months from closing price last Tuesday, the market would never historically be lower than that price last Tuesday. I think we finished in the high 3700s, 3780s, I think. last Tuesday. An additional point that Sentiment Trader offers is even over the next 6 months, there was only a single small loss. Here's the charts that accompany related to volume and advancing issues versus declining issues. So it was actually two breadth studies they're accounting for here in this latest data. Maximum declines, the maximum decline even up to a year later was minuscule on average, though 5 of them suffered drawdowns larger than 5%. 5 had larger than 5% drawdowns, and here's that data. So according to the breadth study from Sentiment Trader, Chris Shivako of Shivako Capital offers those 1-year maximum drawdowns. There was one in 1974, almost 7%. There's the big daddy from the start of the year in 2009 going through the financial crisis, 27%. Here's one in 2011, 9%. Maximum drawdown, again, 7% there in 2011. And the last one is an 8% drawdown in 2015. We already gave up 4% of that 2-day rally in the S&P 500, in the major averages. We've already given up 4%, speaking to the S&P 500, 5.5%, speaking to the NASDAQ. So, is this really going to be 2009? Probably not. So maybe we consider some of these other decent-sized drawdowns. It's to be expected. Bigger picture, that was a significant rally those first 2 days. And historically, 1 year later, market has always been higher. One of the things we talked about in our trading room with Phenom Group members last Friday, because of the soaring dollar, because of the Fed's rate hike policy, I had tweeted this out 1:23 p.m. on Friday. The Fed wants to raise to around 4.5%. At least that's where the terminal rate is at this point, based on their dot plot or their projections. Here's a scenario that I've considered. Thursday CPI. So now Thursday this week, we get the CPI. And if the reaction is bad, we're probably going to see 3,400s. And the dollar is probably going to soar. And the 10-year yield is probably going to climb above 4% again. If all of this comes to fruition, more than likely what we saw in the UK a few weeks ago, where they had to intervene into their credit markets and actually do quantitative easing, as opposed to the tightening that everybody was expecting and they had already started. They had to put a pause on the tightening and actually start QE because they were having, margin calls. Our dollar is fracturing other financial systems. Central bank policy tightening around the globe is starting to fracture financial systems to the point where they may break down. But I'm of the opinion, if this scenario plays out, we're not just going to see issues in the UK, we're going to see issues in Italy and more than likely in Greece. Some kind of bond run, if you will. And if you see issues in these countries, again, more than likely you're going to have an issue in the Eurozone as a whole. Financial systems are likely to break down. So what the Fed wants so far as that 4.5% terminal rate may fall short of if things do actually break down, if we do have financial systems, where there needs to be central bank intervention, providing liquidity, if you will. Just so happens a few hours later, 3:30, Kyle Bass basically feels the same way. Kyle Bass of the Hayman Capital Fund. The Fed is going to go hike another 75 basis points, and they are going to break something. Average mortgage rates in the U.S. are now 7%. Average mortgage payments have doubled this year, and yet they think that keeping their foot on the pedal of rate hikes is going to kill the inflation they brought about. They are going to wreak havoc on emerging market and break something big. Remember 94, 97, 98. Get ready for some real excitement early November. because the rate hike isn't until November, more than likely, at the November 2nd FOMC meeting. Now, again, this is just speculation. I'm not trying to scare anybody. The good news here is you break something, you got to fix it really quickly. It could be a painful several days, maybe even a week in the markets, equity markets. But as soon as the Fed has to intervene and change from tightening to easing, if not pausing, the markets are going to swiftly recover after they've retrenched. Why? Because the dollar is going to come back down in recognition that the Fed is stopping. Yields are going to start falling because they're going to start pricing in that slow growth and the possibility of a recession getting pulled forward. All of that works out favorably for equities. It's just a matter of suffering through the initial stage of financial systems breaking down. But just like COVID, it's a very quick liftoff from there. Again, not a forecast, but some game theory that I discussed last Friday in the trading room with Phenom Group members and in our weekly research report. Heck, the United Nations is calling on Fed and other central banks to halt interest rate hikes. And again, I'm not the only person that feels this way, although I might be, quick, to disseminate these notions, this analysis or calculus. Other very prominent, Wall Street elite, if you will, have considered the very same thing. Ed Yardeni of Yardeni Research. Bond vigilantes are back and could target heavily indebted Italy. I sometimes wonder if these people are following my tweets, right? I'm thinking in terms of why did I come up with Italy and Greece? Debt to GDP ratio. These countries are heavily indebted when it comes to their economic output as a ratio of performance. So, all right, with that being said, I hope you enjoyed our review of our weekend research report. Again, if you're not subscribed, tons of information in here. Again, a lot of what we do, fundamentals, technicals, quantitative data galore, as well as disciplined investing strategies. And being a disciplined investor keeps, a very even-keeled emotional quotient regardless of the market conditions. With that, I'm Seth Golden. Have a great trading week, everybody.